Corporate Finance Excel Practice Problem. In this presentation, we're going to work a practice problem in Excel. It's going to be a comprehensive practice problem for ratio analysis. We're going to be having the balance sheet and income statement and doing our common ratios with them, grouping those ratios into categorizations of profitability ratios, liquidity ratios, debt utilization ratios, and asset utilization ratios. Get ready. It's time to take your chance with corporate finance. Here we are in Excel. We're going to have our information on the left-hand side, and we're going to put that information into the blue area into our worksheet on the right-hand side. We're going to have our balance sheet and our income statements, so the financial statements, the point-in-time statement, balance sheet, income statement, performance statement. Then we're going to be having our ratios on the right. We're going to group those ratios into common categorization groupings: profitability ratios, asset utilization ratios, liquidity ratios, and debt utilization ratios. So let's go right through these. These are going to be our common ratios. This is the most common way that you would kind of see the ratio analysis happening, meaning we're going to have basically the financial statements, and then we'll calculate the ratios upon them or using them, and then we'll use that for our analysis. So this is a really good overview problem. You get an idea for the ratios in total and how to derive them from the actual financial statements. And then you want to practice other problems where you might be using these numbers and they might mix them up in different ways so that you can understand the relationships better. So we got the profitability ratios. We're going to start with the profit margin percent. So the profit margin percent is going to be the net income or earnings after taxes, and that's going to be divided by the sales. So this is all income statement type of activity, and we're talking about profitability ratios. So we're talking about kind of, activity ratios, or how we're doing performance ratios, because we're talking about profitability. How profitable are we? What's the performance we're talking about? So you would think there would be an income statement element involved in these types of ratios, because that is the performance statement. So the earnings after taxes, or the net income, is going to be the bottom line of the income statement. So I'm going to say equals all the way down to the income statement. We're talking earnings after taxes, bottom line, or net income. We're going to compare that to the top line of the income statement. That's going to be equal to the sales item top line of the income statement. Let's go ahead and put an underline here, home tab font group underline. Let's do the division problem. This will be equal to the earnings after taxes, or net income, divided by the sales. Formatting this as a percentage, go into the home tab, numbers, percent, adding some decimals. We could add multiple decimals. We're going to typically round it to 2 decimals. So there's going to be our first item that represents, basically, we're picking up for every dollar sold, we're keeping 5 cents and 5.53 cents, or for every $100 sold, we're keeping $5.53. Is that good? It depends on the industry and our analysis of our past analysis as well, what we've been doing in the past, performance-wise. So I won't say that every time, but just keep that in mind for most of the ratios. You have to do a lot of these ratios in context with yourself, what your past performance is, and the market in terms of the industry. Okay, now we'll do our return on assets. This is like our return on investments we talked about. ROI would be return on investments, or ROA. So return on assets. So we have our assets in the company. How well are we utilizing those assets? We're going to be taking our net income, or we can call it the bottom line of the income statement. In this case, we're calling it earnings after taxes, which is basically the net income bottom line. We're going to be comparing that then to our assets balance sheet item. So balance sheet, we're comparing that to our assets. So that's going to be this item, total assets. Now remember, you might see this because we have a balance sheet account and an income statement account, or income statement compared to balance sheet, timing differences there. Income statement has a range, balance sheet point in time. Therefore, you might see the balance sheet given in some problems as beginning plus ending divided by 2. So just keep that in mind. It depends on the context of the problem you are working with. So then we're going to take the net income, bottom line of the income statement. I'm going to say equals and go all the way down to the net income on the income statement. Then we're going to be picking up the assets, which are going to be on the balance sheet. So here's the total assets on the balance sheet as of a point in time. And that's going to give us our profit margin percent. That's going to give us our return on assets. Return on assets then are going to be here. That's going to be equal to the earnings after taxes, or net income, divided by the total assets. Let's go ahead and then go to the home tab, numbers, make that a percent, add some decimals. We could keep going. We're going to round it typically to 2 decimals. We'll round it out to 2. Let's put an underline up top, home tab, font group underline. So 12.02, again, is that good? That measures our return on our assets. What we have the assets in order to generate revenue. This is net income, bottom line of the income statement, net income. So is that good? Depends on past performance and on on industry standards. Let's take a look at the return on equity now. Return on equity is calculated as net income, or we're going to take that earnings after taxes again, which is going to be an income statement, bottom line of the income statement, net income. And we're going to be comparing that to the total stockholders' equity, which is a balance sheet item. So we're going to take the total stockholders' equity. And so and remember that total stockholder or net income is an income statement item. Total stockholders' equity is a balance sheet item. Therefore, we have a timing issue. It might be in some problems, or they might be asking for the beginning, or what they would call the average equity, which would be beginning equity plus ending equity divided by 2. So be aware of that anytime you have a ratio that has a income statement account and a balance sheet account. That could then be the case. So also note that the stockholders' equity represents the book value of the company, because the accounting equation can be written as either assets equal liabilities plus equity, or assets minus liabilities equals equity. So assets minus liabilities equals equity. This should be an equals equity. Would be like equity being kind of the book value. So now we're comparing earnings to basically the book value of the company. So we're going to say, all right, the net income, once again, down here, performance, how we did in relation to kind of like the book value of the company as of a point in time, which is going to be the total stockholders' equity here. We'll divide that out, and that'll be our return on equity. The return on equity then is going to be equal to the 114 divided by the stockholders' equity. Let's make that a percent. Home tab, numbers, percent. We'll add some decimals. You could keep on going. We'll stop it at 18.91. Now we're going to go on to the utilization ratios. So asset utilization ratios. So we have our turnover ratio. We have the average collection period. We have the inventory turnover, the fixed asset turnover, the total asset turnover. All right, so we got the asset utilization. So we're going to have the receivable turnover. That's going to be calculated as sales. Going to take the sales number. That's an income statement account divided by the receivables net. Now, when we say and we could say sales, let's pick that up this way, just so you can see it. It's on the income statement down here. And we're going to divide it by the balance sheet account of receivables net, meaning receivables net of any allowance. So if there was a contra account right under this that said allowance for accounts receivable, meaning these are how many receivables we have. The allowance represents what we think is not going to be collected on based on past history. We're taking the net of those accounts. So once again, we have the sales income statement account, timing being a range of time, the balance sheet account being the accounts receivable. Therefore, we have two different timing areas there. So that means that the accounts receivable in some contexts may be in the formula of average receivables, which is typically beginning receivables plus ending receivables divided by 2. That's going to give us our receivables turnover. So we're going to take our receivables turnover then. Then we'll pick up our sales. So we'll pick up our sales, which are going to be this $2,060,000. We'll pick up the receivables. So the receivables are going to be up top, and that's going to be the $178,000. Then we'll divide those out. This is going to be equal to the sales divided by the accounts receivable. Then I'm going to add some decimals, go into the home tab, numbers, adding decimals. Again, you can keep going. We typically stop at 2. So I'm going to put some underlines here, home tab, font group, underline there. We'll put an underline here. So that's going to be our receivables turnover, how many times the receivable is turning over. Once again, is that good? Well, it depends. Depends on industry standards, and it depends on our past history. Now, it might be easier for us to see this in terms of the collection period, meaning how many days it would be outstanding, how many days it's going to be outstanding. So there's a couple different ways we can do this. We can call this the average collection period, or basically days receivable is outstanding. You might hear this ratio. One way is we could say, hey, look, let's take the days in a year, which could be 365, closer to normally accurate. You know, there's different years could have different days and whatnot, but 365 is closer to accurate. Or we can use some kind of rounding to try to make this as even as possible in terms of every month we're estimating having an equal amount of days for statistical purposes. So we're going to do that here. We're going to say this equals 12 times 30, and then we're averaging every month having about 30 days, and that would give us a nice even 360. And then we're going to take that and we will divide it by the turnover, receivable turnover that we just came to, and that'll give us our collection period in days. So the receivable turnovers is this 1157. Let's make that a decimal. Home tab numbers, adding the decimals. Let's underline it while we're here. Home tab underline. Then we'll calculate this as 360 divided by that amount, the 31. It gives the 1157 gives us 31 days. Now, you might think about this a different way, that we could think about the average collection period. If you were just to kind of mull it over yourself and say, well, let's think about this. I could start with the receivables. You could say, receivables is going to be this. I'm going to say these are the account receivables. And we're assuming that the receivables were all there, or the sales are all basically credit sales, meaning we have a company that makes sales basically on credit and therefore has a receivable that they're going to be collecting on. So just note, when you have the sales, you could have a company that has cash sales and some that have credit sales. We're going to assume these are all basically credit sales. Then we're going to have these sales per day. So we're considering the sales. We'll break out the sales per day. So we could say, okay, let's pick up the sales number on the income statement. So sales number on the income statement, this is our revenue number for the period, is going to be this 2,060,000. And then you could say, let's break that down to the sales per day, averaging the sales per day. And let me do that again, sales per day. And I'm going to paste it 1, 2, 3. And that's going to be, I'm going to say the days, once again, 12 times 30, which is 360 days. And that's going to give us the sales per day. And I'm going to indent these now by going to the Home tab, numbers, increase the indenting. Indent this one, Home tab, alignment, increase that again. And I'm going to put this into the outer column now. This is going to be equal to the sales divided by the 360 days. Going to put an underline here, Home tab, font, underline. So that means our average sales is about 5722. So then our average collection period, wrong area, hold on a second, as if we would be then equal to the accounts receivable divided by the sales per day. So that would give us our 31. Notice the 31 might be rounded, so we could say it's 31.11, adding some decimals. So we always have to deal with that rounding being a factor. Okay, so now let's look at the inventory turnover. So we're going to consider the inventory turnover with the use of sales. Notice that the top line item mean we're going to take from the income statement sales. Sometimes it might be represented with cost of goods sold there. So just be aware of the context in which you're calculating this. It could be sales, could be cost of goods sold when you're thinking about inventory turnover. So be aware of that. Then we're going to divide that by the inventory, which is a balance sheet account in the other current assets. And once again, we're comparing something that's on the income statement, time range, to something on the balance sheet, point in time. Therefore, the balance sheet might be given in some formulas as average inventory, which you would generally take the most common average, beginning inventory plus ending inventory divided by 2. We're going to pick up the inventory given here. That's going to be the 295. 295, and that's going to give us our inventory turnover. Inventory turnover, then it's going to be equal to the 2,060,000 divided by the 295. We're then going to add decimals, home tab, font group, add decimals. We could keep on going. We typically stop at 2. So now we got the inventory turnover. It turns over 6.98 times about. Again, is that good? Well, it depends on our past performance and on the industry performance. So then we're going to go down to the fixed assets turnover. So let's think about the fixed assets turnover, which we're going to be picking up the sales. So we'll pick up the sales once again. Income statement account, top line of the income statement. This is a measure of how efficiently we're using our property, plant, and equipment, our depreciable assets. So the next item is going to be our fixed assets or depreciable assets or property, plant, and equipment. That's going to be our balance sheet items, which are going to be like those long-term items. And we're going to pick it up the net amount, which is going to be net of any accumulated depreciation. So we're going to pick up the total for the property, plant, and equipment, in other words. And that's going to be the 339. Once again, you have the sales compared to an income statement account compared to a balance sheet account. So you may see this as requesting average plant and equipment, which would typically be the normal average beginning plus the end of the year divided by 2. And then we're going to have our fixed asset turnover. So just be aware of that anytime and that happens especially with these turnover ratios where we're comparing an income statement account and a balance sheet account. Then the turnover is going to be this 2,060,000 divided by the net plant. Let's add some decimals, home tab, font group, adding a decimals. We could keep going. We typically stop at 2. Let's go ahead and put an underline here. We'll put an underline here. So that is a measure of how efficient we are with relation to the use of our fixed asset, depreciable assets, PP&E, property, plant, and equipment. Is that good? Depends on past performance and industry standard. And then we're going to look at our total asset turnover, which kind of summarizes this entire thing, right? Now we're thinking about the comparison of sales compared to the total assets. How efficiently are we using what we have in terms of total assets? So once again, we're going to be picking up the sales. That's like the point of what we're doing, right? To generate and increase sales. That's why we have the assets and whatnot. We're going to compare that to the total assets. Once again, we have an income statement account and a balance sheet account. Therefore, you might see this formula represented as sales divided by the average total assets, most common average being beginning assets plus ending assets divided by 2. So we'll then pick up the total assets. Total assets are going to be this 948.2, and that's going to give us our total asset turnover. So the total asset turnover then is going to be equal to the sales divided by the total assets. We're going to add some decimals, home tab, numbers, increasing decimals. We could keep going. We're going to stop it typically at 2. So then let's put an underline up top, home tab, font, and underline. So total asset turnover 2.17. Again, that's how many times, that measures the efficiency of the use of our assets. Is that good? Depends on past performance, industry standards. Okay, so now we're going to go back up, and in order to see our information, I'm going to hide some cells now. So we're going to hide some cells. I'm going to put my cursor on D, the actual letter, so I see that drop down, and left click, and I'm going to select on over to J, D to J, let go. So we went to DJ. And then we're going to right click on DJ, the selected area, and hide it. Don't delete it, but hide it. So now we've got our information where we're going to put our data right next to our financial statements again. So now we're going to look at liquidity ratios. Now these are some of the most common ratios you'll look at because these are the ones that are like, can we pay our current debt? Can we pay off the liabilities that are coming due? These are often done for banks that are concerned with a loan or something like that. And they want to make sure that you can pay off your current obligations as they become due. So these usually some of the first ratios that people start to know. The first ratio people start to know typically is the current ratio. Again, very common. That's why we break out on the balance sheet the current assets and the current liabilities so we can compare the two, because again, we're concerned, can people pay their current liabilities? Because if they can't, they're in trouble, right? So we want to be able to compare those two. So we're going to say, all right, the current assets are going to be equal to the 548, and then we're going to compare that to the current liabilities. Notice we're comparing two things on the balance sheet, two things as of a point in time. Therefore, we don't have any kind of average thing happening where the two things that are involved have the same time frame, which is a point in time. So then we're going to be dividing this out, the current assets divided by the current liabilities. Going to add some decimals, home tab, numbers, adding some decimals. Again, we could keep going. Got to round somewhere. We're going to round it to 2. So that means we could cover our current liabilities. We can pay off our current liabilities almost 3 times, 2.95 times over with our current assets. So is that good? Well, it's good that we can pay them off over that many times. But again, what would be normal? We'd have to compare it to past performance and industry standards. But we, of course, want this to be over 1 for sure, because we want to make sure that we're able to pay off the current liabilities, which are going to be coming due in a year. And if this is under like 1 or something like that, pretty much universally we'd be like, okay, well, you're gonna have to do something because you're gonna have some liabilities coming due, and it doesn't look like you can pay them, right? So let's go to the home tab font, and we can underline. Now you might say, hey, look, what if there was a crisis or something, and you got all this current assets is largely inventory. Like, what if there was something where you had to shut your stores down or something like that? Then you're not going to sell the inventory, and you're not going to be able to get the cash in order to pay the current liabilities. So then you could say, okay, let's restrict the top line, and let's restrict it to what might be sometimes termed quick ratio or acid ratio sometimes. And let's go to the acid assets, or the quick assets are 2 terms you might call that. And typically we'll take out basically the inventory there. So we're going to say, okay, we still got cash. We still got the marketable securities. We could sell those. We're still going to assume we're going to collect on our receivables. They're already net of the allowance, because we would put the allowance for doubtful accounts if we don't think we're going to collect on them. So let's just take out the inventory and say, all right, then if I say equals the sum of everything but inventory and the current assets, cash, marketable securities, receivables there, or you can calculate it as equal to the current assets minus the inventory in this case, and you'll get to that number. And then we're going to compare that to the current liabilities. So the current liabilities are going to be the same. We're not changing that one. So we'll just pick that up as is. Let's put an underline on it. Home tab font group underline. This is going to be our quick ratio, or sometimes called acid ratio. This is going to be equal to the quick assets or assets, and that's going to be divided by the current liabilities. Add some decimals, home tab. Font, we're going to add a couple decimals. We could keep on going. We typically stop at 2. So note this number is always going to be lower than the current ratio, because we're always going to lower the top number unless there's no inventory, where they might be the same. But almost always it's going to be lower or the same, right? It could possibly be the same. So we're going to have always a lower top number. Bottom number will remain the same. So current ratio 2.95, but what if there's a tragedy or some kind of catastrophe and you can't sell your inventory? Well, then we could still pay off the liabilities coming due with the current assets 1.36 times. So again, it would be nice for this one to be over 1 almost universally, but how high do you want it to be? It kind of depends on industry standards. Okay, and then we're going to go down to the debt utilization ratios. So debt utilization ratios, including the debt as compared to total assets, and then the times interest earned. So we're trying to consider, the debt as compared to the total assets, and then whether or not we can pay off the interest on the debt. So when we think about debt, again, debt's one of those areas that's debatable in finance. How much debt is good? Because how much leverage do you want in the company? Because a certain amount of leverage could increase sales beyond what it could be. But of course, if you go too much debt, then you can have a problem. You want to be able to pay the debt, and you want to make sure that you're not exposed to too much risk by having too much leverage. So there's debate about the debt. So let's do our first one, which is the debt to assets. And when you see a ratio like this, it is exactly what it sounds like. They're just saying debt, which is liabilities, compared to the assets, right? So, and that means we're just going to divide them out, and that's going to give us our debt to assets. So we'll take a look at the debt, which we're going to say liabilities, everything we owe, all liabilities. We're going to say this is our total liabilities. That's going to be a balance sheet item, total liabilities. And we're going to be comparing that to our total assets. So we'll compare that to our total assets, which is going to be here. There it is. Total assets. So we're comparing how much, and remember our accounting equation as we think about this, our accounting equation being assets equal liabilities plus equity, which can be rewritten as assets minus liabilities equals equity. So we're thinking about assets is what the company has, liabilities and equity is who has claim to it. So we're considering then of the assets, the liability portion of the claim to those assets as opposed to the equity portion. In other words, the liability and equity would be 100% claim. So whatever we get from the liability compared to the assets, then 100% minus that will be the equity compared to the assets. So for example, if we divide this out, liabilities divided by the assets, make that a percent. We're going to go to Home tab, numbers, percent, add some decimals. We can add more decimals. We typically stop at 2. So we're saying, let's stop at 2, and let's underline this one, Home tab, font group, underline. So we're going to say, okay, so the liabilities are claiming 36.41% of the debt. Notice what that means is that the equity, if we take this equals 100% or 1 minus the 36, then we're going to say percent, add decimals, then 63% of the assets are claimed by equity, right? And you would think that you would want more claimed by equity, more of the assets to be claimed by equity than being owed to a third party. But again, you know, if you have a certain amount of leverage, it could be good if you're using that leverage effectively to increase revenue. But too much leverage, then you're going to be in danger of not being able to pay. And if there's a catastrophe or a problem, especially an unforeseen circumstance, a black swan event or something, then you're going to have a problem there. So there's debate over how much leverage is good, and it's going to once again depend on the industry, what you're looking to do with it. And then we're going to say then we have the times interest earned. So the times interest earned is typically going to be the income before interest and taxes. So we got the formula over here. So income before interest and taxes. Now that seems like an unusual number. I always miss the E when I say before, but it seems like an unusual number. But what it means is, of course, if we look at our income statement, we're looking at our performance statement, and we're saying, okay, here's the net income. But what I'm looking for is to see how many times over we can pay the interest expense. How many times over could we pay the interest expense? And this is useful to like a banker as well as the company to determine if they can at least pay the minimum that's due on the debt. So if we took out a loan, in other words, we got the loan on the books, we got the purchasing power, we just need to pay like the rent on the loan at the minimum and make sure that we can do that. So how many times over could we pay basically the rent on the loan, which is the interest? To do that, we can't take net income because we already deducted the interest. So we want to remove the interest from net income. And we can't just remove the interest really because the taxes are affected by the interest because it's deductible for taxes. So the taxes kind of mess everything up with that calculation. So we're going to remove taxes because it just muddies up the waters, and we're going to remove the interest expense from earnings. Now that happens to be taking us right up to the operating profit here. So you could calculate it as simply being the operating profit, or you can do, if you don't have this multi-step income statement that works that way, then you can take net income and remove the taxes and the interest. So let's do it that way just to be more specific. We're going to say, all right, we're going to take the net income, then we're going to add back in, which is removing from the calculation because it was subtracted to get to net income. We're going to add back in the taxes, and we're going to add back in the interest. And that'll get us to the operating profit, the 220. So there's our 220. So I wouldn't remember it as operating profit, however, right? I would remember it as income before interest and taxes. So that if you're given just net income and you got to back out the interest and taxes, then do so. Okay, so then we're going to take the interest expense, which is going to be the $30,000. That's the cost of us renting the money in essence, and that's going to give us the times interest earned. Times interest earned is going to be equal to the 220 divided by the 30,000. Let's add some decimals. Home tab, font group, adding decimals. We could keep on going. I'm going to keep it at the 7.33. Let's put an underline up top, home tab, font group, and underline here. So we could say, okay, if we had a loan, we can pay off the interest basically over 7 times over. So again, what's a good number for that? It depends on the industry and whatnot. But if you're a bank, the higher that number is, the more likely, the better you feel that they can at least pay the interest, the rent on the loan.